You once described yourself to me as a node in a neural network, which I thought was a really interesting image. And the more I observe you, the more I've seen that this is one of your great competitive advantages, that you're surrounded by people in your ecosystem who wish you well and want to help you. And it's a remarkably powerful thing. It's a different way of playing the game. And I guess it sort of plays to your strengths as well, because you're a sociable, gregarious guy. But I'm wondering, was there somebody you saw, whether it was your father or Buffett or someone at Graham Holdings or whatever, that you looked at and you're like, that's a really smart way of operating in the world, or not just smart, but decent and right and feels good?
Right. Well, the answer to your question is yes. There are people who have managed to somehow be around or bump into or be exposed to that taught me those lessons, and have done it over and over and over and over again. So one of the first ones would have been my father, because I was a kid and I was around him and I observed him in that way. And the public figures that you speak of, somebody like Don Graham or somebody like Warren Buffett, I've observed that in them personally for multiple decades and have learned that as an adult. But it doesn't grow stale or it doesn't grow old. And as recently as within the last 30 to 60 days, there was a circumstance and a situation in Richmond, Virginia, where there was a gentleman, and I've known this guy reasonably well. We're not real close, but I've known him reasonably well for probably the better part of 35 or 40 years. And there was and he's reasonably well known around Richmond. He's successful, both in the terms that the world might immediately jump to as successful, but he's also successful in that I know his children, and they're good people. They're fun to be around. They have not been warped by affluence in the way that some are. They are successful as well. And I think when you see that sort of kindness and love-based and trust-based, that is both financially and in human terms successful for multiple generations, you're really looking at something special, and you ought to pay attention and try to learn something from that. And I was in a conversation with him, and somehow it came up that he said, well, he gets up every day, and the first thought he has is, how can he do something for somebody? How can he help somebody? Now, if somebody who I did not know for 35 or 40 years, and I was meeting on first occasion, and I didn't know a single thing about him, there's a natural skepticism that one has when you hear somebody say something like that, because you wonder, what's their angle, or what's going on here really? But as you get to know somebody and you can have some sense personally that is indeed genuine, and you can see 35 or 40 years of track record of how it's worked out for that person, because I think he really does mean what he says, and he does that over and over and over and over again. Again, I've tried to live this. I've certainly been exposed to it and been taught that from my earliest memory, but yet here it is within the last, like 60 or 90 days, there was an occasion where I had a chance to drink a cup of coffee or talk to somebody who I knew a little bit. And that was his core message, just getting up in the morning, like, what can I do today that will help somebody? And I've seen him do it for 40 years. So you learn those kinds of things that are exposed to them on a regular basis.
It's curious how this turns out to be incredibly helpful, even in the investment business, which we kind of assume is this ultra competitive zero-sum game where somebody has to suffer for you to benefit. And to some degree, maybe that's true. But I see in your life and in the life of someone like my great old friend Guy Spear, that you guys embody what I call in my book the Mensch effect, where you're Menschers, you're trying to be decent, kind human beings for lots of people. And I see the world kind of organizing itself around you. So there are lots of people trying to help you. And I was chatting with Josh Tarasoff, a mutual friend of ours, the other day, an excellent hedge fund manager, who I remember he was talking to you about Amazon years ago, and you ended up buying Amazon after discussing it with him. And it seems like that's happened to you a lot, right? Where people are exchanging information in a way that's kind of selfless, but maybe it's also because at the time he was invested in Markel. But you have that to an extraordinary degree, and it's instructive for people, because I think it suggests that there's another way of going about business and investing that's actually it requires a degree of courage, right? Because it's not just guarding everything for yourself.
Well, it's both courage and cowardice at the same time, because if you really And all these things tie together. And I think the time frames in which you're talking dictate so much of how you would frame things. So if you're talking about a short-term situation where you're trading, I don't know, pick whatever it is, that Bitcoin or pork bellies or options, which tend to be measured on day-to-day, if not moment-to-moment, or second-to-second, or nanosecond to second kind of measures, those do tend to be win-loss games, and there's zero sum. And if you win, somebody else loses. But when you stretch those time horizons out over 5, 10, 50 lifetime kind of measurements, I think you have the opportunity to play win-win games. And that's just an entirely different way of thinking. And as an illustration of that, of how this can be so successful from a business point of view, I can remember a couple of years ago at the Berkshire annual meeting, and Charlie Munger, who oftentimes just puts his finger right on it in terms of behavior and just trying to be stand-up people and do the right thing and think longer term. He said in response to some question, how do you do it? How do you do it? How do you do it? The endless questions of young, agilent types trying to figure out Berkshire. He said, look, we were two guys talking on the phone, and now we are bigger than General Electric. That should not have happened. And he was just trying to illustrate the point that General Electric was a company that in many ways lost its way. It had huge, epic advantages. You go back 50 years ago and you look at whatever collection of businesses at whatever place in society General Electric occupied versus whatever position Berkshire Hathaway occupied 50 years ago, I think it would have been hard to foresee and bet and predict that Berkshire was going to be the one who would be more successful in many of the measurable metrics that you would think about. But that is indeed what happened. And Munger would suggest the word that he likes to use a lot is rational. And he would say Buffett and he do their best to make rational decisions day after day after day after day. I would extend that and say rationality looks different when you're playing a finite win-lose game than what it looks like when you're playing an infinite win-win game. And I think it was James Corse, if I'm remembering the name correctly, who wrote about the infinite game. And he talked about, in a finite game, there are rules. There's a period of time, it's finite, and there's a winner and there's a loser. And that's the definition of a finite game. Infinite games tend to not have so many rules, and they don't have a time horizon attached to them. And the only prime directive that exists in an infinite game is that all of the players of the game have to feel that they're winning, because if they don't, they're going to stop playing and the game is no longer infinite. So I just want to play an infinite game. And then I'm fortunate in so many ways. The advantages I had, the upbringing, the education, the base of never worried about where my next meal was going to come from or getting a good education. And I would extend that to the next most substantive thing that happened to me was getting married to Susan. And I was married to her by age 19. I knew a good thing when I saw it. And she's been a spectacular partner that in so many ways has undergirded so much of what I've done. Because she was gainfully employed and frugal and just always took care of 75% of my life, that I was really able to concentrate on this piece of my life and know that she had me covered for everything else. So that kind of partnership is a crucial component of how these sorts of things unfold and happen over time.
Yeah, she's a remarkable woman, and she runs a good business too.
She does indeed.
For people who don't know, Tom's wife, Susan, who he met, I think, when he was 15 and went on his first date at the custard stand in Salem, New Jersey, now runs a very successful business for Markel as well, and is a remarkable person. So, Tom, the first stock you bought back at Markel when you took charge of the investment portfolio in 1990 was Berkshire, back when I think the stock was at around 5,750, and now it's what, 467,000, something like that.
Something like that.
How does it embody the four filters that you have for looking at a business? Because it's obviously it's grown to, I think, the best part of $1 billion, your stake in Berkshire. If we're trying to explain to listeners what a good business looks like, what a business that passes these four filters looks like, how is this in some sense the perfect embodiment of that?
Well, it's like the old joke, if you wanted some word definition in the dictionary, you looked it up and there was somebody's picture there. Well, if you want the embodiment of what the four filters of the four lenses that we use to think about investments, and you open the book, it would be the picture of Berkshire there. So each of those four filters, first off, a good business that earns good returns on capital without using too much debt to do it. So if you look at the returns on capital that Berkshire has earned in the various businesses they've been in for a long period of time, they are very good. And they've spoken and written and acted in such a way that they've talked about, it's not that debt is wrong or there's any moral dimension to it. And it's not that they don't use some debt, but they use very little and comparatively less than most other people would in the same situation or circumstances. And the reason for that is debt introduces fragility into the system, that you might be very good at what you do. You may have a fine business, but if you have an interest bill that comes due at an inopportune time, you may lose the opportunity to continue playing your infinite game. So step number one, good business, good returns on capital without too much debt. Check, check, check. Lens number two is management teams with equal measures of talent and integrity. And so many of these lenses, I did not make these up myself. I learned them from people like Buffett and Munger and so many others. But if you look at how they have behaved over so many years, clearly the returns on capital that Berkshire's own suggests the talent that they have and the talent that is embedded within the entire system of Berkshire, and the behavior, the personal integrity. They've always given the shareholders an epically good deal in terms of their cut. They've made the vast majority of their wealth through owning Berkshire shares and enjoying the exact same economics as what a shareholder does. It's not economics that they would have earned as managers rather than shareholders. So that's the test there. Point number three, and this is really where Berkshire has distinguished itself and in so many ways set the role model and the example of what we're trying to do at Markel, is does the business have capital discipline, and can they find acquisitions to reinvest the cash they make, or have capital discipline in terms of being good at acquisitions or share repurchases or dividend payments? Well, Berkshire had a tiny business 50 years ago, and they made money. And up until within the last year or two, they had taken on the challenge of reinvesting that money in their existing businesses or new businesses through acquisitions. So if you think about an Olympic diver, and you're judged not only in how well you execute the dive, but the degree of difficulty of that dive. So if you have a very good business and it makes excellent returns, but you pay the money out in dividends or share repurchases on a pretty regular basis, well, what you're doing is a dive of only a certain degree of difficulty. If you take it's a swan dive, and you could do it and get a 10.0, but if it's just a swan dive, you will only get but so high a score, because the degree of difficulty involved in doing that is not as much as when you introduce the triple axel, reverse, lunge, twist kind of dives. Those dives are harder to do, and to execute them well and with the same degree of precision that you can execute a swan dive, that's how you become an Olympic champion. And if you look at Berkshire's behavior and execution of an incredibly difficult dive for 30, 40, 50, 60 years, that's what makes Berkshire special, is that reinvestment lens and that reinvestment aspect, the third leg there. And then the fourth, and it's really the least important, is price discipline. Can you buy this at such a price that the returns of the business itself are going to roughly match what you as a shareholder receive? And that just means don't pay so ridiculous a high price when you find those three things, that the fault is yours in your execution of the purchase decision, rather than what intrinsically happened at the business itself. Now, here's where the advantage of being part of the structure at Markel is so helpful. I spend the vast majority of my time on seeing whether those first three lenses are there. And if they are, and even if I conclude that this thing is way overpriced, I usually make myself buy just a little bit of it. And then 3 months or 6 months go by, and I sort of revisit my thesis, and I think about whether those first three factors are still there. And if they're there in strength, I make myself buy a little bit more. And then sometimes there'll be extreme dislocations in the markets, or for some reason or another, the price will change. Well, by virtue of already owning a little bit and making myself familiar with it, it emboldens me psychologically to take a bigger swing when something like that comes along. And even if it never gets to the point where you think, wow, this is an incredible price, but you keep thinking this is incredible business, if you find yourself buying it every quarter for year after year after year, and you're right about your underwriting decision on those first three aspects, you end up with a spectacular investment, because the price you pay gets overtaken and swamped by the quality of the business itself.
And in a way, it's the same lesson as your IRA, right? Where as a kid, where you just keep adding to the pot through thick and thin. And then you look back 30, 40 years later and you're like, wow.
Right. And I know oftentimes people are kind of confused by, they see the long list of stocks that we own and they think that, wow, that doesn't seem very disciplined, and it seems sort of splattered all about. But that's really the farming process. There are a lot of seeds that are planted to see which things are going to emerge and which of those seeds. To go back to your Peter Lynch idea, he talked about the foolishness of selling your winners, and he called that picking the flowers and watering the weeds. And talked in his book, which my grandmother gave me, by the way, I remember that, the discipline of not taking a profit prematurely, which is a human tendency. You want to do that. You celebrate the victory lap, the checkered flag rises. And getting back to my IRA story, I remember this vividly. I came this close to doing something truly, truly, truly stupid with my own Home Depot story. And fortunately, I talked myself out of it, or somehow or another, I averted this particular trade. So coming out of the housing crisis, Home Depot was really doing quite well. I mean, they proved that the renovation model, as opposed to new construction, was more durable, just operating really well. And I thought for a nanosecond, especially because it was in my IRA, I could write covered calls on it, to generate a little more cash and have a little more cash to invest. And fortunately, that thought passed before I did so, because had I done that, those calls would have been exercised, and that Home Depot would have been sold in 2011 or 12 or something like that. I would have missed the last decade, potentially, of what came from owning Home Depot, because I would have taken a short-term win and celebrated a win and had a great trade, but missed an epic sort of moving the needle kind of company that has influenced the investment results, not just for my IRA, but for Markel in total. That's our third largest holding. So it matters.